Daily market analytics, new trading week, welcome back. I wanted to show you this very interesting trading opportunity that I'm not currently involved in, but I do plan to pull the trigger on this one if it will go the right way. So straight from my market watch list, this is probably one of my top favorite trading opportunities waiting to get triggered. This is the Swiss versus the Japanese yen, and you're looking at the daily chart. You know we were already heavily involved with the upside move that preceded this drop we had in the last few days here. So we were already having a bullish position, which went very well up until price began to turn around. And as it did, I began to pull out and eventually pulled out altogether, made a bit of a profit, nothing to write home about, but I do want to get right back into this one as it begins to turn around again. I think we're about to end this downside correction. Now, when we were looking at the bigger picture, which comes from the weekly chart, we saw this really impressive trading range that you can track back all the way to the beginning of 2017. And up until now, we've had a pretty well established, I would say probably 5 legs here, right? And now, when you take a look at the situation, obviously price came from the very edge of the setup, touching base on the bottom and last line of support here, 105.73, bounced back all the way. Even it bounced back so strong, it actually made it all the way above the mid-low key level. Also a very significant support, 109.45. You can see it right here. And ever since then, of course, we saw price trying to challenge that 109.45 from above, but kept failing until it started to break away to the upside. Now, this upside move, I think, was just right now was corrected, right? This whole drop we had here last week was a technical downside correction, and I want you to focus on this blue dotted line. Right, when you see this blue dotted line on 109.97, and that happens to be a 61.8 Fibonacci correction. All right, one of the most important Fibonacci correction levels, 61.8 of the previous opposite move, right, the upside segment. So, and you can also see the lovely reaction we're getting here, right? So I'm talking about last Friday with a slight touchdown here. Price basically bounced back up, and even today we see price basically keeps battling against that 109.97. So you can already guess what my game plan here, right? So I want to take a second bullish campaign. I think we can catch the next upside segment, which could go straight up to our old price target, the mid-high key level at 113.60, right? That was our final destination, and it remains the same. However, I'm a bit concerned about pulling the trigger right now because this is the 61.8. Now, quite magically, the 76.4, which is the last line of correction, falls exactly, just precisely. You can try this yourself, right here on the 109.45, right? So it's perfectly in line with the mid-low key level, and that could also suggest that price on the downside here did not end its mission. So it may drill a little bit lower just to touch base on that 109.45, which is also the 76.4 last Fibonacci correction, and only then begin to turn around, right? So I want to stay cautious here. And here's what I'm about to do. If price will show some resilience here on the upside, meaning it's going to begin to turn around, I would like to see a couple of green bars, right? Basically, I want to see price above 110.50, breaking above Friday's highest high, and beginning to look positive. That's where I'm going to pull the trigger here, right? Or, of course, if price will continue to drill lower, only once it reacts to that 109.45 and begin to turn around, that's going to be the moment that I'm going to pull the trigger. So either one of these scenarios, but I'm very interested in picking up again the Swiss yen for the next bullish campaign, which I think is imminent. Alright guys, that's about that for this one. Swiss versus the Japanese yen, increasingly interesting. I'll follow up and keep you posted. See you on the next one.